Let's talk about personal finances. In this video, we're going to talk about budgets, the value of a college education, and medical insurance. There are 4 steps to creating a monthly budget. The first step is figuring out what your monthly income is. You want to definitely include money that you bring in from a job, but you also want to include things like scholarships or a college fund. And if these are things that you get annually, you want to divide them by 12 so that you can figure them out as part of your monthly income. Step number 2, this one's the hardest. You've got to figure out what all of your monthly expenses are. These monthly expenses include a lot of different items, such as your housing costs, car expenses, food, utilities. Are you putting money away towards savings? What you pay for your phone, insurance, entertainment, loan, and credit card payments. Step number 3, your goal is getting a cash flow of 0. That's the total money that's coming in for the month minus your total expenses. Remember, money that you're putting away towards the savings account is included as a total expense. So any money that you've got left over, you want to earmark for savings so that this cash flow, total income minus expenses, gets close or actually equal to 0. Step number 4. It's going to take a lot of adjusting. You're going to have to rework some things. You got to figure out how you can lower your expenses. How can you increase your income? How can you lower those loan payments? Or even better yet, how can you avoid more loan payments? Where do you start? The very best place to start is with the previous month. However typical or untypical it might be, it's really good to go through your bank account and figure out how much you actually paid for things like food, insurance, gas, phone, entertainment, and if you put anything away towards savings. You want to add these up to get a realistic idea of what you should be spending. As you're including things, make sure that you're including any expenses that happen maybe semi-annually or quarterly or annually. Insurance payments, car insurance, for example, is often paid semi-annually. You want to include these in your monthly expenses by taking the value and dividing it so instead it's a monthly expense. There are lots of really great free budgeting tools that you can get either online or for your phone. You can even just do a simple budget in Google Sheets or Excel. The important thing is to be able to manage your money by understanding exactly what money's coming in and, more importantly, what money is going out. Next is the value of a college education. What do you actually gain financially by getting a college education? This graphic shows us weekly earnings based on the amount of education you have. The weekly earnings are done as a median. Medians make the most sense here because if we do an average, we're taking people that make very little and trying to average them with people that make maybe millions or more a year. So in this one, so you take a look at the associate's degree. Somebody with an associate's degree makes, as a median, $798 a week, where somebody that has a high school diploma makes $678 a week. You'll notice that gray line right down the middle is the median for all workers of any education background, and that's $860. We're going to focus in on the earnings for somebody with an associate's degree compared to somebody with a high school diploma. This data is collected by the U.S. Bureau of Labor Statistics, and it was collected in 2015. So it's not completely current, but relatively speaking, we can still get some really good information out of this. You'll also notice that the unemployment rates drop as your education goes up. Okay, so let's say that we're looking at people that are employed and they were 25 years and older, someone that has a high school diploma versus someone that has an associate's degree. Remember, these are statistics, so we're looking at everybody that has a high school diploma versus everybody that has an associate's degree. People make more than this, people make less than this. The median yearly salary for somebody with a high school diploma is right around $35,000. while the median yearly salary for somebody with an associate's degree is about $6,000 more at about 41,500. Okay, let's see what this looks like over the course of a 40-year career. So let's say that you're 25 years old, you've got 40 working years ahead of you, and you're going to retire at 65. The person with a high school diploma earns over their lifetime, using that median yearly salary, earns about $1.4 million. The person with the associate's degree earns about $1.65 million. The difference over a lifetime is nearly $250,000. I also did this number comparing somebody with a high school diploma and I took the number for somebody with a bachelor's degree, somebody with a 4-year degree. When we take their earnings and stretch them out over a 40-year career, somebody with a bachelor's degree makes almost $1 million more than somebody with a high school diploma. $950,000 more over a 40-year career. So as you're thinking about how much money you're putting towards your education, you also want to consider how much that's going to increase your earning power over your lifetime. Health insurance options. It's really important to understand how health insurance works, how the costs work, and what you can expect to be covered. So there's some important vocabulary terms that go along with health insurance. The first one is premium. The premium is the amount that you pay. Some of us are very fortunate, like myself. I pay for part of the premium, and my employer, the college, pays another part of my premium. So we share in that premium. The annual deductible, mine also does have an annual deductible. I believe ours is $2,500. So the annual deductible is the amount that you need to pay out of pocket before medical insurance starts to kick in. And the copayment is separate from the deductible. So the copayment is the part that you need to pay for each type of service. So some people, a very common copayment is a $25 copayment for every office visit, and then your insurance will pay the rest. Even with really good insurance, things still can add up. So here's an example of an emergency room visit. So let's say that you had to go to the ER in January and you received a $7,000 bill. Maybe you had a couple of tests run. There could have even been an ambulance ride in there. I mean, it adds up quickly. So this person has pretty good insurance. Remember I said my deductible was $2,500 a year. This one is $1,000 a year. So this person has a $1,000 annual deductible. None of it's been met yet because the ER visit was in January. They also have a special ER copayment. So this would be different than an office visit copayment of $250 per visit. And ER coverage is 80% of the remaining balance. So just walking into the ER, it's going to be $250. Let's go ahead and figure out what the actual price owed of the $7,000 bill is. I've written everything out. Over on the right in gray is the balance, and notice how it starts with the $7,000 bill. The next transaction is the deductible. Since you haven't paid any out-of-pocket expenses yet, since it's the beginning of the year, you have to pay that $1,000 right off the top. That gets us down to $6,000. Okay, the next piece is the copay. This was an ER visit. It has a $250 copay. So far, everything in red is what you're paying, or the person is paying. That brings the balance down to $5,750. Now we're up to the insurance coverage. The insurance is going to cover 80% of the remaining balance. So they're going to pay for 80% of $5,750. So they are paying a really big chunk, and that chunk is $4,600. That leaves a balance of $1,150, which is your remaining out-of-pocket cost. So if we add up all of the costs in red, the $1,000 deductible, the $250 copay, and the remaining balance, we end up with $2,400. So that out-of-pocket cost is $2,400. Now, if we back this up just a little bit and assume that this is later in the year and you've already met your deductible, you've already spent $1,000 towards medical insurance or medical expenses, so you know that the insurance is going to kick in, you can take the $1,000 off of the total out-of-pocket cost that you're paying. So it would be as low as $1,400 if it were later in the year, but if you hadn't yet met that deductible, it would be the $2,400 that you're seeing here. We're going to do many more examples, so take a look at my skill building videos.